Afternoon, everybody. Dwayne Shopper there, DRFX Trading. Today, I'm going to take a look at the situation on the Kiwi Japanese yen pair. Basically, going to be looking at the patterns that have presented themselves over the last couple of days to identify if there are any swing trading opportunities that might present themselves over the next couple of days, heading into the middle of May. So, as you can see from this chart, this pair has been in a very strong uptrend that started in 2009, early 2009. Connecting the first support point with the next one that was formed, I believe, in 2014, 2012, we get what is essentially an outer uptrend line that was formed to define this pair. Following this was an inner uptrend line that was also formed when the market rallied over the last few years to form this high at just above the $94 area. Zooming in, we can see what that price was actually. That area was actually at the 93, 96 area. So a very strong uptrend that has been in place for this pair, and based on the patterns that we're now seeing that have taken shape, that have appeared in the last year, this trend appears to be gradually coming to an end. Now, as you would probably have noticed already, the pattern that was formed in this sideways movement is actually a bear crown or head and shoulders pattern. What we have here is actually a pennant setup that was broken, which would be the left tip or the left shoulder of this formation. And following the breakup, bullish about the resistance of this pennant, the market then plateaued and to form a pair of double tops, pull back to the inner uptrend line to essentially form the head or the center tip of the crown, and this was followed by a rally back above the inner uptrend line to form the right tip or the right shoulder in the form of another pennant consolidation. So this has been the situation over the last several weeks, the formation of this right tip, right shoulder above this inner uptrend line. Now, bear crowns, head and shoulders, double tops, double bottoms, as well as large consolidation breakouts are typical of what you would see when the market is coming to a gradual end. A particular trend is coming to a particular end, and a major change in the trend direction is actually going to take place over subsequent months. And the larger the setup, the larger the signal, the more likely that setup will lead to at least a year or two in movement in the opposite direction. So this is essentially what you would normally see. The left tip taking on any formation on just before the market comes to a gradual end. A center tip or show or head that is usually a U-turn that pulls back briefly to the trend line and then breaks it, followed by the formation of the right tip that then leads to the breakout to the in opposite direction to start a new trend. So this situation is similar to what actually took place on the Euro Canadian pair. This pair was actually in a very strong uptrend as well that eventually came to an end with the formation of its own bear crown last year. As we can see here, there was a very strong uptrend that started in 2012, formed several uptrend lines, and a long-term uptrend line, an outer uptrend line, as well as an inner uptrend line. As now zooming in, we can see that the bear crown setup was not as large as the one that we have on the Kiwi Japanese yen. However, it is very noticeable, and it started with the left tip over here, which was essentially a breakout of a counter trend line, a rally, and a U-turn to the inner uptrend line, followed by the break and the formation of the right tip or the right shoulder in the form of a pennant consolidation. Following this, the market eventually broke the support to start the downtrend, breaking these trend lines along the way, the outer uptrend line as well as the long-term uptrend line. And what we have now is essentially a very strong downtrend that has been formed since that bear crown appeared and led to and started the breakout on the downside with a break of this right tip, the right shoulder, breaking the support and starting and breaking, subsequently breaking these outer uptrend lines to start a new direction in favor of the Canadian dollar. So this is a setup. This is a similar setup that we're seeing unfolding on the Kiwi Japanese yen, and given the large size of this formation, it is very likely that the next move, the next direction, will be to the bearish, to the downside in favor of Japanese yen. Now, consolidations on a whole, in generally, by themselves in isolation, they generally have a 50-50 chance of breaking out in either direction on either side, bullish or bearish. However, one must always ensure that you look at them within the context of the larger situation taking place. So given the size, given one, the fact that we have a bear crown setup, and two, the size of this, the large size of this bear crown setup, it is very likely that the next direction is going to be bearish rather than bullish. So we're starting to see some form of a rally taking place right here, just between the support boundary and the uptrend line. You may actually have a rally that probably takes us to the resistance, followed by some more movement within the pennant. But it is very likely that eventually that is going to give way to a bearish breakout to break both the support of the pennant as well as this inner uptrend line, this major inner uptrend line as well. So that if we do get that, and assuming that it is in the form of a normal candle, which is the typical breakout candle that you would want to trade, because those candles generally give profitable breakouts and are very likely to lead to profitable breakouts rather than volatile or reversals that take out our trades and carry the pair to the opposite side of the pennant. So assuming that that is what we see in the next couple of days, and that the signal and the setup on the 4-hour chart are in keeping with the trade rules that I have in my trade sheet here for analysis on the daily chart as well as the 4-hour chart. Once the setup and the signals that I see on that pair conform to these patterns, to these criteria, then it should provide us with a green light to trade this pair for 200 per gain. Now, assuming that takes place and that our entry price will be around the $88.40 area, that 200 pip trade is not likely to take a very long time to be hit. 88.42, 86.42 will be the target, thereabouts. Based on the size of this consolidation and the fact that we are going to be breaking out of a consolidation pattern in general, the market is going to move pretty quickly to that target, and so that profit that would be offered from this trade is likely to take only about 3 or 4 days to be hit. So let's wait to see what takes place in the next few days. Hopefully we get a nice breakout that can be traded. The market may provide a signal independent of what takes place on the fundamental side for that pair. Reason being, I'm not seeing very many important high impact news items for either New Zealand dollar nor the Japanese yen. This by itself is significant, but in terms of the movements on the higher time frames, it's not going to be very significant. So let's wait and see what takes place, and hopefully we can get a good trading opportunity. Take care.